All right, good morning. It's Jacob Field here again from Ripe House, and today we are joined by another very special guest, Mike Mortlock from MCG.
You just got to remember the cricket ground.
No, I always get confused with your name, Mike. We've known each other for many years, so I do apologise about the stuff. I do know your business name, and you are blocking it in the background as well, so it looks like you've got some buildings coming out of the top of your head.
There we go.
Very good. Hey, thank you for joining us today. Mike is definitely one of the good guys. He's one of the most informative and up-to-date and knowledgeable property people in the industry. Always brings a unique and humorous slant to, I guess, a very important but often overlooked subject, which is depreciation, maximising your tax with your property portfolio. So thank you for joining us today, Mike.
Pleasure. Thanks for having me on.
Beautiful. And we have had a quick chat beforehand, and I've prepared some questions for Mike today, but we also do have some others that have come through in the last hour or so. If you do have any questions for Mike, any conversations, about tax, depreciation, how to maximise the benefits from your property, please let us know. This is not designed to be, I guess, a high level or introductory session about depreciation schedules. We can definitely do the 101 stuff to start with, but let's actually, I guess, dig into it a little bit deeper and work out ways where we can maximise tax through renos, through the types of properties we actually purchase in the first place. Because, we might make money up front if we do our job right. We might make money through rent and, ongoing buying and selling of property, but it's the holding period that, we really need to maximise the amount of money that we put into our pockets. So that's what it's all about today. So don't hold back. How does that all sound to you, Mike?
Sounds great. Yeah, throw whatever you like at me. I'm happy with whatever questions. I apologise for the tax depreciation joke that I've shared in this Facebook group, but I intend to bring way more value than that in the future.
All right. Let's start with the 101s then. So what does a quantity surveyor do?
Yeah, it's probably best described by estimating construction costs. That's our special skill set. So I have a Bachelor of Construction Management, and that is, I guess, it's the whole gambit of construction. It's, contracts admin, it's project management and that sort of thing. But in the eyes of the tax office and where it comes to tax depreciation, we are the best qualified people to estimate the construction values and the plant and equipment values within a property. And of course, we need to be registered tax agents as well. As part of what we're doing is we're seen as providing low-level tax advice as well.
Let's just rewind that and unpack it, if that's all right. So when you say you've got a qualification in estimating value, that's important to people who have purchased a new property. Obviously, the land itself cannot be claimed, but the cost to build the premises, that land appreciates. It goes up in value is the theory, and the building and the plant, and internal furnishings, which you might be able to fill this in, depreciates in value. And let's just say it cost you $200,000 to build the actual dwelling on that land. That $200,000 can be claimed back as a capital loss. If it goes down each year in value, Mike is the expert at, I guess, let's just say, for example, it goes down $10,000 in value in that first year. That is $10,000 that, a certain percentage of it comes off your taxable income for that year. Is that correct, Mike?
Yeah, absolutely. And that's a good way to describe it, because a lot of people aren't really aware of what the benefit is. And like, oh yeah, you get a tax depreciation schedule, you'll get some tax deductions. But what it means in real terms is that in the eyes of the tax office, your income is diminished by the amount of tax deductions you claim in that financial year. And you can go to the ATO simple tax calculator. I wouldn't if you don't need to. That's up for boring people like me to do with their weekends. But If you are on $100,000 a year, the last time I did it, you're paying about $24,000 in tax. Now, if you're on $89,000 a year, it's about $20,000 in tax. So the difference is about $4,000. So if you're on 100 grand and you have $11,000 worth of depreciation deductions in that financial year, it's around $4,000 back in your pocket. So that's the actual benefit of depreciation from I guess your back pocket point of view.
Yeah, and so that's the important point. If you're sitting on a property that has been built, okay, and there's certain requirements around that. I think it's after 1983. Correct me if I'm wrong again.
Yeah.
1987.
Yeah.
The capital cost of that dwelling can be claimed as and depreciated against your taxable income. So as you just said, $11,000 in capital depreciation on the assets that you own can save you $4,000 a year in tax that you're paying. That's dinner once a week. That's well on the way to saving a deposit for a home over a few years, just in those savings.
I've been out to dinner with you and Anna once before. I think that's probably dinner once a month, to be honest. You guys are pretty premium, but yeah, it's a significant amount of cash. And using your example of, let's say an investor builds a new investment property for 200 grand, really the minimum they're able to claim is $5,000, because the lowest depreciation rate is for the building structure, and that's 2.5%. So you're getting 2,500 for every 100,000. So in that scenario, it's $5 grand. But in real terms, you would have the plant and equipment items actually taken from that 200. So if it costs 200 to build, then you might have 20 worth of carpets, blinds, kitchen appliances, and they all depreciate at a lot higher rates. So that same property, you would normally expect to be returning somewhere around the $7,500 to $8,500 worth of deductions in the first full year.
Wow, it's a big difference. So that's probably moving to the next point. If we definitely advocate, especially in these interesting times with COVID, entering into a property and structuring that entry, the property, to minimise risk to us as much as possible. So higher yields, minimise that, or go a long way to minimising the reliance on capital growth. If the worst was to continue occurring. Buying under the fair market value for that property, that's potentially money made on entry, lowering that risk that if there is a black swan event that occurs, Donald Trump, catches COVID, whatever it might be, we've got a buffer there in the value of the property. The other one is through capital improvement. So, going into a property that's a little bit tired, not overpaying for it, but, spending that 5%, which is what we recommend on a renovation, looking for that 2-to-1 return on investment. So you're spending $15,000, you're putting $30,000 on the value of the property. That $15,000 reno, Mike, can that be depreciated?
Yeah, that's an extra bonus. So I think it's worthwhile talking about the two different categories of depreciation and then the qualifying parts around them. So when I was talking before about a brand new property, you'll be able to claim all of the components of depreciation. And really the two sort of buckets, for want of a better term, is the plant and equipment items, the carpets, blinds, kitchen appliances, and then the building structure. So to claim plant and equipment items, you either need to buy a brand new property today. So this legislation came in 2017. So you can't claim plant and equipment if you buy a 1-year-old house anymore or a 20-year-old house. You can only claim it if you either buy brand new or you actually install the asset yourself in a renovation. So if you're buying a 30-year-old property and you're doing $15,000, let's just say you just do the carpet, then you've got the $15,000 of deductions on the carpet. And that depreciation rate on the carpet is 25%. So it's 10 times higher than the building structure. So plant equipment is one category. Then you've got the structure itself. So in that renovation, let's say you're spending 15 grand and 10 of it was on construction components. So that would be things like kitchen cabinetry or tiling or gyprock. Then you're getting 2.5% as a depreciation rate on that $10,000. So that's not a huge amount of cash, right? Because of that depreciation rate. And on that,
per annum, isn't it, Mike?
Per annum, yes. So
with over 40 years.
40 years, yeah, from the date of the work. So if you buy a property that was built in 2000, you'll be able to claim 2.5% of the construction value each year through to 2040. And as you mentioned before, the cutoff date for claiming the original structure is the 16th of September 1987. So if the property is built after that date, you can claim 2.5% of the construction value as at the time that it was built. But if it's built before then, and a lot of investors will buy properties that are built prior to that date, in our data, it's around about 30% of people. You can claim the structural or the Division 43 deductions on renovations. So if the original structure doesn't qualify, but you put in a kitchen and a bathroom, then you will be able to claim the capital allowance as part of that. So the cupboards, the bench tops, that sort of thing, and even the previous owner as well. So if I buy a property that was built in the 20s from yourself who renovated last year, I'll be able to claim the structural improvements that you've done to the property.
So, I mean, that's probably an important point. The depreciation or the opportunity to depreciate the cost, that goes with the current owner of the property. So that person, obviously, who did that reno, they've been able to claim 1 year until they sold, 2 years until they sold you the property. They can't continue to claim that depreciation, ongoing after they've sold the property. Then, you can, as the current owner of that property. Look, this is probably, it'd be nice to get some comments here, and for those, there are comments coming through with questions, but just before we get to those questions, for those of you that do own investment properties, let us know. Yes, we do own investment properties. That would be great. And I would like to also get a bit of a feel for how many of you with investment properties actually have those properties with depreciation schedules for them. It would be interesting to know, Mike, on that, how, from your experience, what percentage of people do have depreciation schedules for their properties?
It's something that companies have tried to work out in the past. The only way to do it is to look at the ATO tax stats, and you see who is actually claiming some deductions. So there's an argument to say, well, they must have a schedule. The issue is that it depends how long they've owned the property. So they may have had a depreciation schedule, but all the values have worn out. So it's difficult for us to tell. Certainly, I've spent a good decade educating people on the benefits of depreciation, but as a bit of maybe something that will illuminate some of the problems with people not understanding depreciation, comes from some data that we crunch, where we looked at a sample of 1,000 of our residential tax depreciation schedules, and we found that 6.7% of people waited so long to get the schedule that they missed out on deductions. So you can back claim 2 financial years. So we're actually talking longer than that. So these are people that waited more than 2 years. And the average amount of deductions that they lost was 20,537 from memory. It was 530 something. That's a significant amount of deductions. So that just goes to show that the education is not necessarily there.
So that's literally someone who is paying tax on $20,000 worth of income each year that they shouldn't be.
Yeah, well, that is the total amount. So there were people within the sample size. There was one particular lady who purchased a property off the plan, so a brand new unit, 16 years before she contacted us. So from memory, she lost $65,000 worth of tax deductions over that period. So there was a sizable back claim for her, but it was a significant amount of deductions that were lost. And if it's 60 grand of deductions that you've sort of foregone, that could comfortably be $20,000 from your actual pocket.
Yeah. And that's probably a good point. So you can go back and review 2 financial years worth of tax returns and retrospectively modify them.
And you would need your accountant to do that. So you'd need to actually amend prior returns.
Well, first step is have a chat to you, obviously, and get the schedules done. And then if you think that there is going to be some significant savings on the depreciation side of things, then you would prepare the certificate, and then you would, the investor would take those to their accountant. Is that what you're saying?
Yeah, and they're probably going to charge you a fee to amend the previous returns. But if you're back claiming $5, $10, $20,000, it's probably a no-brainer. But it's much better to get a depreciation schedule as soon as you purchase an investment property, just so that it's done, you don't forget about it, and you don't miss out on those deductions. And everyone kind of hates homework and tax time. I mean, I'm a tax guy, but I hate doing my tax return. I don't even physically do it. I just mean hunting down the information and sending it through. It's not one of those sort of things that fills your heart with joy. But it can cost you a fortune. So it's worth, being a bit diligent with it.
For everyone that's on the line, though, and obviously the people that look at the recording over the next few days, if you're sitting there with a portfolio of investment properties and you haven't got depreciation schedules on them and you have a job, so you earn income, then you're probably sitting there, not in all cases, but you're probably sitting there on a reasonable sum of cash that you can potentially have in your pocket within the next few weeks, is the idea.
Yep.
This is not a sales pitch, and I don't have shares in your company, Mike. This is just I'm having conversations with people in the industry who can paint a bit of a break open some unknowns, because if this is the case and you're sitting here in this scenario, then you could be literally weeks away from a few $1,000s being returned to you from the ATO, and we can put that towards another property. You can do whatever you like with it. But it's important stuff that we need to know. It's not just when you go and buy a property. If you haven't got one already, then I'd recommend at least having a chat.
Yeah, for sure. And I care more about the education and the client claiming their deductions than using me. There are other quantity surveyors out there. So if you're not going to use me, use somebody else. Just claim those deductions, unless you're wanting to. One of the other tax depreciation firms came up with the phrase, "Don't tip the tax man." I think that's pretty catchy, because that's sort of what you're doing.
It's good. Yeah, it's good. And the only thing that really gets me out of bed is, with what we do at Ripe House, is just making sure people actually generate wealth from property investments, because the majority of people don't. And it's not rocket science when you've done it before. There's a lot of little gotchas, and there's also, you've got to eke every single dollar out of every investment that you have. And if you're not, then it's stepping you back, and potentially it's introducing, if you're not maximizing returns, then risk, can sometimes rear its ugly head. So look, I'm going into a bit of I guess a segue and a sidetrack here, which is not intentional, but we do have some comments that have come through. We do have some questions that have come through. I've got one here. I actually can't see people's names when it's coming through on this software. So thanks, Mike, for the session. What do you do differently? So what do you do differently to create an online depreciation schedule versus a physical visit? And what do you recommend, A or B, for a 10-year-old property that is in original condition with no renos or additions post-purchase?
So recommendation, a non-physical inspection versus an inspection?
Yes, for a 10-year-old property that is in original condition.
That's an easy one to answer. I would never recommend getting a depreciation schedule on a 10-year-old or even an established property. So not a brand new property where you have the construction costs and the plans and the schedule of finishes without an inspection. I was on a call with the Australian Institute of Quantity Surveyors yesterday, sort of working on formulating a bit of a consumer guide, because there are a lot of quantity surveyors out there that are recommending a non-site inspection style schedule. Now, there's a couple of cases where it might not necessarily be required, but they are relatively unusual. One example is if the quantity surveyor has been involved with the project from start to finish. So, for example, they might be doing progress claims on that development on the bank's behalf. So they've seen the original plans, they've charted the progress of the construction from start to finish, they're familiar with all of the costs, and they've inspected it multiple times. There would be no need to go back to do a tax depreciation schedule. That's probably the best example of when you don't need an inspection. The other time would be if you buy or you build a brand new property and you know exactly how much it cost and you've got the plans and you know all of the equipment in there. But there's even problems with that where we recommend an inspection, because often it'll say stainless steel appliances, and there's a big difference between, say, a Gaggenau oven, which can be 20 grand, or a Technica oven, which you could probably get for $389 on sale at Harvey Norman. It also might say carpet to living areas, but is that the hallway. It doesn't necessarily show it on the plan. Most of the time, I would recommend a depreciation schedule have an inspection. If it fits those two cases, perhaps not. But certainly, if you're buying something that's not brand new, then you shouldn't really be doing an online style depreciation schedule. And I think the AIQS will help us to stamp those sorts of offers out.
Beautiful. That question was from Napoon, if I'm correct. I've just been informed. So we've also got another comment from Tim, who said he was surprised with the deductions he got with some of his older properties, although have some minor upgrades. So I struggled to do two things at once, so I apologise, guys.
That sounds like a good story. Everyone likes to be surprised on the upside, don't they?
It is a good story. Look, in terms of, please keep the questions coming through. Mike, if you can hang around, obviously in the Facebook group, you're in it, you're the, as mentioned, there's no financial relationship. I have a long-term friendship and respect for what you do in the industry. So with that in mind, I'd love you to be able to contribute to the group and answer anyone's questions ongoing.
Of course.
How do people get in touch with you if they want any more details about what you offer?
Yeah, so I'm in the group, of course, so you can seek me out there. The website is mcgqs.com.au. So if you think of the Melbourne Cricket Ground and you add quantity surveyor on the end, you got MCGQS. You can find me on Facebook, LinkedIn, all that sort of stuff. If you search me, you might get Sterling Mortlock, the rugby player, but there's not that many Mortlocks, so just keep scrolling until you find me.
Really quick question here from Kemi. This was asked yesterday, I think, on the forum, so
Yep.
We definitely need to cover this one. She has just bought a 70-year-old 3-bedroom house from an elderly couple who are downsizing. What depreciation, benefits potentially, or taxes should she expect in 5 years?
Very possibly none. Because in that situation, and this is probably the only time we see it, if it's an elderly couple that's been in that house for a decade, they are quite comfortable with that floral carpet that you see from the 1950s that most investors or homeowners will rip out straight away. So the only deductions that you would see in a 70-year-old property are going to be based on improvements. So if you bought that, you're not able to claim any plant and equipment items. Even if you did, they might be of such an age that there's not really much left in it. But it just all comes down to any of those improvements, as I mentioned. So in our data, of all the properties built prior to 1987 that we did depreciation schedules, about 64% of them had been renoed, and the average value was just under 40 grand. So if there's a kitchen and bathroom renovation and it costs 40 grand, then that's $1,000 a year worth of deductions. That's about the cutoff point where a depreciation schedule might be worthwhile, or we might recommend it. Certainly if you're renting it out for 5 years, then you get the benefit of the 5 years claim. So the short answer is possibly nothing, which really makes me upset, but look to renovations or improvements or additions, and that might be a new driveway or a carport, or they may have had a new roof put on. Often you can tell that just by looking at it, but I'm happy for you to shoot me through the address of the property and I can do some online research for free as well.
So that's another important point. And also, Kemi, if you were to do a renovation on the property, then that's when you can, obviously that is potentially fully deductible. And then the other point is, I think, Mike, you're happy to have a chat to people about their properties. If you can't see the deductions, then, it's nice to have a chat, but, you can't help them, that's fine. You're happy to work that out for no cost, I'm assuming, and then if you do see that there are going to be deductions that validate or you need to obviously get paid, but if the benefits to the person do cover the costs, then you would say, look, you're going to be actually making money by doing this, essentially.
We turn people away if the deductions aren't such that the report pays for itself. I'm not in the business of selling something that doesn't have a benefit. So yeah, look, occasionally we do say, look, unfortunately, there's not enough value in this particular property for these reasons. So we try and educate the people as to why. And often those people come back with the next property and they say, look, I bought this. Is there anything in it? And they're excited to give me money. You know, it's surprising what happens when you look after people and do the right thing.
That's awesome, mate. I love it. All right, we've got obviously the ability to communicate with you ongoing, Mike, and I really love talking about this and opening up people's eyes to, I guess, some often overlooked ways of generating return from their investments, which is what it's all about. So thank you so much for your time.
Pleasure. Thanks for having me.
Cheers, mate. See ya.
Cheers.